Put the coffee down. Pause the show. Stop pretending that whatever email you are about to answer is urgent, because if you can watch today's market and still worry about your inbox, you're living in the wrong reality. It's Monday, February 9th, 2026. Markets are open. Reality is not. I'm not saying that for drama. I am saying it because what you saw on the screen this morning does not exist in a sane universe. And the fact that it is being treated like a normal Monday is the part that should chill you. You know that feeling when you walk into a room and everyone is smiling a little too hard, as if they're rehearsed, like they all agreed not to mention the smell. That's the market today, grinning through clenched teeth while the pipes scream behind the drywall. And the worst part is how quickly people learn to smile back. Let me give you the scoreboard of the impossible, because the numbers matter, and the vibe matters more. Gold is flirting with $5,000 like it's not a historical event, like it's just another Tuesday, and the anchors can go back to arguing about whether you should buy the dip in some app stock with no profits. Silver is whipping around in the 80s, throwing 5% moves like it's bored, like it wants to remind you it can ruin your week before lunch. And while that circus is on the screen, the boring little footnote that nobody reads is whispering that warehouse inventories are sliding again. Ounces and millions of ounces disappearing from the total, like the system is quietly bleeding in the corner. You're supposed to look at a quote and think, that's the thing. That's the trick. On the screen, it's a number. In your hand, it's real. Remember that while we walk through this mess, because the whole modern financial religion is designed to make you worship pixels and ignore weight. Now, the official story you'll get is a warm blanket made of cheap fabric. They'll say it's profit-taking. They'll say it's positioning. They'll say it's risk on, risk off, like the market is a mood ring and not a battlefield full of people trying to survive. Profit-taking. That's adorable. As if the people moving these markets are your cousin Dave selling half his ETF because he wants a new truck. If this were just profit-taking, why does it always hit like a coordinated strike? Why does it always happen when the plumbing is under pressure and the wrong people are about to get margin called into the sun? Why does it always break the same way, in the same direction, at the same time, like a magic trick that only works when the magician needs rent money? If it's healthy, why does it feel like triage? Here's what you have to understand, and I'm going to say it like we're sitting on the curb watching an apartment building burn. Markets aren't pure. They're engineered environments with valves, gates, and permissions. And the people who own the valves are not the people on your side. You are not a client to them. You're a yield source, a fee stream, a liquidity provider who panics on cue the mark in a rigged card game, who still thinks the house is neutral because it offers free drinks. Think of the system as plumbing, because that's what it is. Liquidity is supposed to flow. Bids, offers, settlements, deliveries, collateral moving like water through pipes. When the pipes are clear, you barely hear it. You just see price discovery and assume it's fair, like rain falling. But when the pipes clog, when pressure builds, when a valve gets welded shut because someone in a suit decided a certain outcome can happen, the water doesn't politely stop. It finds a weak point and it blows something apart. Today smells like pressure. Gold blasting upward while everything else pretends to be fine is pressure. Silver making obscene jumps while people tell you it's just volatility is pressure. And those quiet inventory drawdowns, those ounces leaving the ledger, that's pressure too, because inventory is the boring part. Nobody glamorizes, but it's the part that tells you whether the screen is honest. Let's talk about that inventory for a second, because it's where the story gets physical. You'll hear numbers like combined total inventory, and you'll hear that gold stockpiles fell by a little over 100,000 ounces in the latest report. You'll hear that silver inventories dropped by a few million ounces in the same breath. That sounds abstract until you translate it into something human. That's metal leaving the building, metal not sitting there as a cushion, metal not available to soak up stress when delivery comes and someone wants the real thing, not the receipt. And yes, I can already hear the smug voice in the background saying, but there's plenty of eligible. Cute. Eligible is not a promise, it's a category. Eligible means it's in the building, maybe in somebody's name, and they can choose whether it becomes available for delivery. Registered is the stuff that's actually tagged and ready to be delivered into the contract. When registered gets thin, the market can still quote you a price, but it starts quoting you a fairy tale. This is where the system's little crime happens in daylight. Paper can fake price. It can't fake presence. A futures contract can be printed faster than a cheeseburger receipt, and the system can create liquidity by issuing claims on the same underlying thing over and over, slicing it into derivatives like a magician pulling scarves from a sleeve. But when a buyer stands up and says, I'd like the metal, suddenly you're not in a spreadsheet anymore. You're in a warehouse with forklifts and security cameras and a very nervous compliance team. Picture a micro scene, because this is how it always starts. I'd like to buy some silver, you say casually, like you're ordering socks. The dealer on the other end exhales like you just asked him to ship you a live tiger. Sure, he says. What kind? You tell him. He pauses. Okay, he says. It'll be longer. Longer means the truck isn't coming, the refiner is behind, the wholesaler is rationing, and everyone is pretending it's normal because admitting it isn't would start a run. And then you look back at the screen, and the screen is telling you silver is on sale. The screen always tells you it's on sale right when the real world is starting to ration. On the screen, it's just digits. In your hand, it's survival. That's not poetry. That's the difference between owning something and renting confidence from an app. Now, why does this happen now? Why does it smell like an operation? And why should you care if you're not trading futures like a caffeinated maniac? Because gold and silver are not just commodities, they are collateral. And collateral is the blood supply of the modern financial machine. When you want to knock out an enemy without firing a shot, you don't bomb the tanks, you hit the fuel and the spare parts and the bridges. In finance, the bridge is collateral and the fuel is trust. Gold at 5,000 isn't just investors seeking safety, it's a flare in the sky saying the currency is losing credibility. When everything starts rising together, when stocks can't go down because they're policy and gold can't stop going up because it's reality, that isn't prosperity. That's a currency evacuation drill. That is everyone quietly trying to get out of the building while the fire alarm is disabled because it would cause unnecessary panic. Silver is even nastier because it lives at the intersection of money and industry, like a mercenary that can't decide which war it's fighting. It's used in electronics, solar, medical, defense, and a dozen other places you never think about until they're missing. Somewhere in Shenzhen, a factory manager is staring at an empty pallet where the silver paste was supposed to be, and he doesn't care that New York just printed a lower quote for a few minutes. He cares that his production line is now a very expensive paperweight, and his workers still want to be paid in a currency that buys less every month. This is where East versus West stops being a meme and starts being an economic front line. In the West, we trade derivatives and call it a market. We do data blackouts, technical issues, maintenance windows, and we act shocked when confidence drops. In the East, they care less about your narrative and more about whether the metal shows up, whether the shipment clears, whether the premium you're recharging is a sign of tightness or a sign you're relying. You've heard the phrase arbitrage, right? The whole fairy tale is that if New York is cheap and Shanghai is expensive, smart people will buy here and sell there until the prices match. That's the textbook. And textbooks are what you read right before you get punched in the face. In the real world, arbitrage requires one thing more than math. It requires the pipes to be open. It requires the ability to move metal, to settle, to finance, to insure, to store, and to trust that the other side won't change the rules mid-flight. When the pipes are rattling, arbitrage becomes a hostage negotiation. Can you get the bars? Maybe. Can you ship them? Depends. Can you hedge the exposure? Not without getting margin hiked. Can you finance it? Not unless your bank still likes you. That's how you get a spread that stays wide, and that's how you get a paper price that tells one story while the physical market tells another, with premiums that whisper the truth under the table. And here comes the gaslighting, the psychological warfare portion of the broadcast. They aren't just managing price, they're managing your pulse. Red candles are not just a chart pattern. They are a weapon against your nervous system. They want you flinching. They want you trained like a dog to sell when they bark. Because the most dangerous investor to a rigged system is not the genius. It's the calm person who doesn't panic on schedule. Watch how it works. A sudden smash happens in a thin moment, usually when liquidity is low and stops are clustered like sheep at a cliff edge. The move triggers margin calls, forces weak hands to puke positions, and then the market recovers. And the experts chirp that it was healthy clearing. Healthy clearing. That's like calling a car crash a healthy release of kinetic energy. It's not healthy, it's a selection process, a culling. If you think I'm being dramatic, ask yourself a simple question. If this is just a normal market, why do the rules always change when the wrong people start winning? Why do margins go up when volatility spikes? Not for safety, but right when the public is tempted to participate. Why do position limits suddenly matter when someone wants delivery? Why do settlement procedures get updated when the system is under stress? This is why I call it plumbing and not magic. When pressure rises, the people with access to the valves do what they always do. They restrict flow to protect themselves, and they call it stability. They tighten financing, they demand more collateral, they widen spreads, they slow delivery, they review risk. And if you're small, if you're ordinary, if you don't have a prime broker and a legal department, you feel it as friction, delays, and the weird sense that nothing is quite available at the price you're being quoted. Let me give you another micro scene. So you can't sell me the coins you listed, you say. Why, we can, the dealer says, and you can hear the smile in his voice like a bandage over a wound. But the premium is higher now. Why, you ask? The price is down. He laughs, a tired laugh, the laugh of a guy who's explained gravity to too many people. Because the price is down, he says, and the wholesaler's out and the mint is backlogged, and if you want it, you're going to pay for reality, not for the quote. That's the availability versus quote problem, and it's the crack where the whole system eventually splits. The crisis doesn't start when the price spikes. It starts when someone says, "I'm sorry, there's nothing left to sell you." You can have a quote in a dying market the same way you can have a temperature reading in a patient with no pulse. The number exists, but the life behind it is gone. Now, why gold? Why silver? Why now? Because these metals are the lie detector for currency. You can massage CPI, you can seasonally adjust unemployment until it looks like a straight A student, you can redefine what counts as a recession, you can do a million little narrative tricks. But you can't print ounces. You can print claims. You can print ETFs and futures and unallocated accounts and synthetic exposure. But you cannot print weight. And when the system starts to wobble, the first thing the adults do is secure collateral. That's the part they don't tell you because it sounds paranoid until it happens to you. Banks care about being paid back. Governments care about financing themselves. Institutions care about meeting redemptions. And when trust gets thin, they reach for the assets that don't depend on someone else's promise. Here's where the heist metaphor fits, because this isn't just a market move, it's a transfer. Imagine a crowded theater where the exits are small and the lights are dim. Someone whispers fire quietly to the people in the front row, the ones with good seats and insider access. They stand up calmly, they walk out, they don't panic, and the rest of the audience keeps watching the show. Then the smoke gets real, someone finally pulls the alarm, and suddenly the doors are slammed with bodies. The people who left early are outside breathing clean air while everyone else is fighting over oxygen. Gold at 5,000 looks like the front row leaving. Silver's violent swings look like the crowd starting to notice smoke. Inventory drawdowns look like the exits narrowing. And the official story is the theater manager on the intercom saying, "Everything is under control. Please remain seated." You want to know what really happens when things are under control? It means someone decided who gets protected and who gets sacrificed. There are sacrificial assets in every crisis, things they let burn to keep the structure standing. In 2008, it was certain mortgage bonds and certain banks and certain homeowners, and everyone pretended it was an accident of excess. In the next crisis, the sacrificial asset could be your purchasing power, your pension, your cash savings, your ability to buy necessities at the same price next month. And the dirty secret is that sacrificing purchasing power is politically easier than sacrificing banks. You can't tell people their bank is insolvent without riots. But you can inflate quietly, you can devalue slowly, you can call it stimulus and support. You can blame supply chains and weather and greedy corporations. You can make your currency bleed out like a patient losing blood under a blanket. And as long as the screen still shows your bank balance, you'll tell yourself you're fine. This is where the building metaphor starts to matter. The elevator's going up. Stocks go up, real estate goes up, gold goes up, sometimes even junk goes up. And people celebrate because up feels like winning. But if the elevator goes up because the building is collapsing beneath it, you're not rising. You're just falling slower than the floor. When everything goes up together, nothing is winning. The currency is losing. That's the line you tattoo on your brain, because it explains why gold can soar while the economy is strong. And it explains why silver can untee sit still while the experts grin and call it healthy. This isn't volatility, it's confession. Well, let's get technical for a minute, because you deserve the mechanics, not just the mood. Futures markets are supposed to be tools for hedging. Miners sell forward. Refiners hedge input costs, manufacturers lock prices, and speculators provide liquidity, allegedly. But when speculative paper overwhelms physical, the tail wags the dog. Price becomes a function of leverage, margin, and positioning, not a function of metal. That us is how you can have a world where a massive number of silver contracts trade in a day, representing multiples of annual mine supply, and the talking heads still call it a market. It's a market the way a casino is a market for chips. The chips are not the stake. They're a mechanism for moving money around a table, and the house controls the table. Now add in rehypothecation, because this is where the comedy turns into horror. Rehypothecation is the practice of using the same collateral more than once. It's like telling two different people that the same car is theirs because you gave both of them a photocopy of the title. As long as neither tries to drive it at the same time, you look like a genius. The moment both show up with keys, you look like a criminal. That's why delivery matters. That's why registered versus eligible matters. That's why inventory trends matter. They tell you whether the photocopies are starting to get called in. And when you see inventories slipping while prices are screaming, you should not relax. You should assume someone, somewhere, is choosing reality over paper, and the system is trying to keep you calm while it adjusts. You'll notice how glitches and maintenance always show up right when the pressure peaks. If this were just a glitch, they'd fix it. If the data feed goes dark at exactly the moment the numbers burn the people who ordered the code, that's not a bug. That's a fire door slamming shut. They don't turn off lights to help you see. They turn off lights to control who moves in the dark. And here's the part they'll never say on TV. The point of an exchange is not to guarantee you get what you think you bought. The point of an exchange is to manage the flow of obligations in a way that keeps the institution alive. That sounds cynical, but it's not even evil. It's just survival logic. When the system is stressed, the system prioritizes itself. So you get cash settlement, you get force majeure whispers, you get rule changes, margin hikes, and sudden risk reviews. You get friendly experts telling you not to worry because the market is deep and liquid, while every dealer you call is quoting wide spreads and telling you delivery is delayed. You get a split reality where the screen is smooth and the real world is jagged. On the screen, it looks like a game. In your hand, it stops being pretend. That's why they spend so much effort keeping you glued to the screen, because as long as you believe the number is the thing, you won't ask for the thing. Now let's talk about silver specifically, because silver is where the system gets weirdly emotional. Silver is small enough to be bullied and important enough to matter. It's the kind of market where a coordinated hit job can send it down hard, trigger a wave of liquidation, and then let strong hands scoop exposure cheap. It's also the kind of market where industrial demand is sticky, where the real-world need doesn't disappear just because the chart went red. So silver becomes a theater, professional wrestling. Two giants in shiny shorts pretend fighting while the referee pretends not to see the folding chair. One side slams paper, the other side quietly takes delivery, and the audience is told it's price discovery. If it weren't tragic, it'd be funny. And you, sitting at home, are being trained to confuse motion with truth. A 5% move is made to feel like the whole story, like you're watching the real economy. But the real economy is a factory waiting on supply, a refiner juggling orders, a mint backlogged, a vault watching outflows. The real economy is not the candle. It's the shipment. Here's another micro scene. Where did the inventory go? You ask someone who works near the flow. He looks at you like you asked where air goes when you breathe out. It went where it always goes, he says, to whoever showed up with money and no patience. But the price, you say. He shrugs. The price is a story, he says. The metal is a fact. That's the war zone difference. Stories are cheap. Facts are heavy. Stories can be rewritten, revised, corrected, and blamed on a misprint. Facts show up in the form of empty shelves and delayed shipments and premiums that don't come down, even when the chart says they should. Now, you might be thinking, okay, fine, this is all ominous, but what's the motive? Why would anyone want to smash price, restrict flow, play games with spreads? Because controlling price controls collateral values, and collateral values control who lives and who dies in leverage land. When gold rises too fast, it's telling the truth about currency. When silver rises too fast, it threatens to expose a shortage. When either rises too fast, it creates winners and losers, and some of those losers are sitting on books of derivatives that were never meant to be settled in metal. So you get operations, you get precision strikes, you get sudden dumps timed to trigger stops and force liquidations. You get margin hikes that conveniently arrive at peak public interest. You get narratives that blame speculators, encouragement on social media, and anything else that isn't the structure itself. And the structure is this. There are more claims than there is metal. There are more promises than there are ounces. That's not an opinion. It's how leverage works. The question is not whether there are more claims. The question is, what happens when too many claimants decide they want the same thing at the same time? You've seen a version of this movie before. In every crisis, the first stage is denial. It's contained. It's subprime. It's temporary. The second stage is soothing. The Fed has tools. The regulators are watching. Liquidity facilities are available. The third stage is anger, where the public realizes the rules are different depending on whether you're big or small. The fourth stage is acceptance, where people quietly adapt to a new regime while pretending it was inevitable. What you're watching now feels like the early stages of a regime change hiding in candles. Gold above 5,000 is not a normal bull market move. It's a warning flare about the integrity of the unit you get paid in. Silver's violence is not just trader games. It's a stress signal from the supply chain that uses it. And inventory drawdowns are the physical markets slowly tightening the noose around a paper-heavy structure. Let me riff on the plumbing again, because it's the best way to keep you sane. In a healthy system, liquidity flows like water and metal flows like the heavy stuff it is, slower but predictable. Today, the pipes are rattling. You can feel it in the way spreads behave, in the way dealers talk, in the way the screen and the street diverge. When the pipes rattle, the first response from the people who own the valves is to protect the upstream. They don't want pressure to reach the pump. The pump is the banking system, the clearing system, the settlement system. So they create buffers, cash settlement, delayed delivery, higher margin, wider spreads. They turn a free flow system into a rationing system without using that word. And rationing is the moment you should stop thinking like a trader and start thinking like a survivor. A trader thinks, what's the next move? A survivor thinks, what's the thing I can actually get when the doors are half closed? A trader thinks in tickers. A survivor thinks in logistics. This is why I keep coming back to that ugly line. If you can't touch it, you don't own it. You might have a claim. You might have exposure. You might have a beautifully designed app telling you you're diversified. But if you need permission to withdraw it, you're not the owner, you're the mark. I am not telling you this to sell you a fantasy of hiding gold under a mattress like a cartoon villain. I'm telling you because the system is built on layers of trust, and trust is not a constant. Trust is a resource, and it gets consumed in crises. When trust gets thin, the layers matter, and the person closest to the physical asset wins. Look at the way governments and central banks behave, not what they say. They talk about stability while running deficits that require continuous financing. They talk about inflation being managed while your grocery bill laughs in your face. They talk about soft landings while the labor market and credit system do that slow motion wobble you recognize right before a fall. Gold is the scoreboard for that hypocrisy. It's not perfect. It's not magic. It doesn't pay yield. It doesn't fix policy. But it doesn't default. It doesn't get diluted. It doesn't depend on someone's promise. And when enough people realize that, the price is not demand, it's a referendum. Silver is a referendum too, but it's also a bottleneck. The green energy narrative, the electrification push, the defense buildouts, the electronic sprawl, all of it quietly leans on silver. And the silver market is not a bottomless pit of supply. It's a chain of mines, refiners, fabricators, and inventories, and that chain can get kinked. So when you see silver whip around like this, don't just see speculation. See a metal that's being pulled in two directions. As money by people losing faith, and as input by people trying to build real stuff. That tug of war is why silver charts look obscene. It's why the moves feel like crossfire. Now, let's do the sarcasm segment, because it's important for your mental immune system. When you hear strong consumer confidence, translated as, they need you spending because the system needs cash flow. When you hear healthy correction, translated as, we needed to shake out weak hands and reset leverage. When you hear technical glitch, translated as, we turned off the part of the story that was inconvenient. And when you hear, there's plenty of supply, ask the simplest question in the world, can I get it at that price, in that time frame, in that form? If the answer is no, then the supply is not supply, it's a concept. There is a reason the official narrative always sounds like it was written by someone who has never tried to buy anything that matters during a panic. They speak in abstractions, because abstractions can't sue you. Liquidity conditions can't file a complaint. Market functioning can't show up angry, but you can, and that's why they don't speak your language. So let's speak your language. You work, you save, you pay taxes, you try to build a little safety. And then the system does its little daylight crimes. It devalues the unit you save in, it taxes you through inflation, it rewrites rules to protect insiders, and it tells you you're irresponsible if you notice. That is not a conspiracy theory, it's the business model. The next part is where people get uncomfortable because it means admitting the game is not fair. The exchanges are not neutral. The banks are not your friends. Regulators are often captured, not because they're evil villains twirling mustaches, but because the revolving door is real and incentives are gravity. Media is not there to inform you. It's there to keep you calm enough to keep participating. And participation is the lifeblood. They need you in the system. They need you trusting the screen. They need you believing that a claim is as good as an asset. Because if too many people demand delivery, demand withdrawal, demand physical settlement, the system has to reveal how much of it is built on promises stacked like Jenga blocks. Ask yourself, if everything is fine, why are inventories trending down in key places? If everything is fine, why do premiums refuse to die? If everything is fine, why do maintenance messages appear at the exact wrong moments? If everything is fine, why does the system keep needing emergency language and emergency tools? There's a brutal honesty in physical markets. A refinery can't mark to model an ounce into existence. A miner can't adjust geology to meet quarterly guidance. A factory can't build a solar panel with a press release. Physical is slow, heavy, and humiliatingly real. Paper is fast, light, and easily lied with. Paper can be created, netted, rehypothecated, and rolled. Paper can satisfy demand for exposure, and exposure is what most investors are trained to want because it feels modern. But exposure is not ownership. Exposure is what you have when the system wants you to believe you aren't to be re-protected while it keeps the real stuff for itself. That's why, if you can't touch it, you don't own it. Isn't a slogan, it's a diagnostic. It tells you where you sit in the food chain. If you're holding a claim, you're downstream. If you're holding the thing, you're upstream. And in a crisis, upstream drinks first. Now, none of this means you have to become a bunker dweller. It means you have to think in layers and failure modes. What fails first and what fails last. Promises fail before objects. Apps fail before vault doors. Narratives fail before gravity. You've already seen tiny rehearsals for this. Banks freezing accounts for your safety. Platforms halting trading to protect investors. Exchanges changing rules to ensure orderly markets. Those are the polite phrases for gates slamming shut. Gates don't slam shut when things are calm. Gates slam when the crowd surges. And gold at 5,000 is not a calm signal. It's a crowd signal from the people who think ahead. It's the system's lie detector blinking. Silver's madness is the crowd's nervous system twitching. Inventory drawdowns are the venue staff quietly moving chairs away from the exits. Let me tell you a story about orderly markets. In an orderly market, everyone plays by rules that don't change based on who's winning. In an orderly market, if you buy something, you get it, and if you sell something, you deliver it. In an orderly market, the price is not a policy tool. We do not live in that market, and the sooner you accept that, the less you'll be emotionally manipulated. They will always try to make you feel small, foolish, and alone for noticing. That's the psyop. Only weirdos buy metal. Only conspiracy people care about delivery. Only gold bugs talk like this. Meanwhile, the adults in the room, the ones with balance sheets the size of countries, are very quietly accumulating reserves and securing supply chains because they know what happens when confidence breaks. And confidence is the key word. The financial system is not built on truth. It's built on belief. It's built on the belief that your deposit will be there when you want it, that your bond will be repaid in something worth holding, that your pension will be funded by future growth, that your government will not inflate you into a smaller life. Gold and silver are the ancient opposite of belief. They are the part of the system that doesn't care what you believe. They sit there, heavy, indifferent. And when the world gets weird, they become the mirror everyone pretends not to look into. So what's the hidden mechanism today? It looks like a liquidity assassination with a side of confidence management. Gold's climb is the system trying to price in currency risk while pretending it IMS investor appetite. Silver's volatility is leverage and industrial tension fighting in a phone booth. Inventory drawdowns are the physical market clearing its throat. And yes, there will be days where the chart drops and you feel like an idiot for caring. That's how the psychological part works. They want you to associate pain with holding. They want you to think patience is stupid and panic is smart. But the people running operations don't think in hours. They think in quarters and election cycles and funding cycles. If you want a line that sums up the whole era, here it is. The screen will be the last to admit it. Reality will be the first to punish you. The screen can delay, smooth, and narrate. Reality just shows up. So what do you do with this, besides get mad? First, you stop letting a quote dictate your worldview. You stop acting like price is the same as truth. Price in a leveraged derivative market is often a negotiated outcome, not a discovery. Truth is whether you can settle, source, and obtain what the price supposedly represents. Second, you build your life like you expect gates. You don't bet everything on one pipe, staying open forever. You diversify not just across assets, but across custody, jurisdiction, and access. You ask, what happens if the app is down? You ask, what happens if withdrawals are delayed? You ask, what happens if settlement is cash only? Now, these are not paranoid questions. These are adult questions. Third, you get comfortable being early and being mocked because in every crisis, the early people look crazy until they look obvious. The late people look normal until they look desperate. Normal is not a compliment in a system that profits from your normalcy. Let me bring you back to the moment because I don't want this to turn into philosophy class. Same Monday, same February 9th, 2026 energy, and the market is still pretending this is just another day. Gold near 5,000 is not just another day. Silver throwing wild moves in the 80s is not just another day. Warehouses bleeding inventories while the screen remains smooth is not just another day. This is the kind of day that teaches you what you actually own. This is the kind of day that reveals whether your position is a thing or a promise. This is the kind of day where the phrase counterparty risk stops being a textbook term and becomes a face, a name, a phone call that doesn't get answered. I'll give you one last micro scene because it's the whole story. I want to withdraw, you say. It's my money, you say. The person on the other end says, of course, with that same rehearsed calm, and then adds, there will be a short delay. Short delay is the soft word for we're buying time. Buying time is the soft phrase for we're under pressure. Under pressure is the polite term for the pipes are rattling. When this ends, nobody will care what your screen once said. They'll only ask what you can put on the table. In your hand, not in your app. If you can't touch it, you don't own it. And if you need permission to access it, you're not the owner. You're the mark. So take a breath. Don't panic, because panic is how they harvest you. Don't worship the screen, because screens are where they stage manage your emotions. Respect the weight of reality, respect the fragility of trust, and build your decisions around what survives when the narrative breaks. And if you hear someone tell you today was profit-taking, smile politely, because you're watching a different movie than they are. You're watching a system under strain, a currency slowly bleeding, and a market that's being managed like a crime scene. On the screen, it's a number. In your hand, it's real. Remember that, because the people who don't will learn it the hard way.